I think that there are certainly times when you have high conviction and times when you have a cautious evaluation of the situation around you, and you spend a lot of time challenging your own market biases. And I think this is the latter. I'm still positive on EM Asia, and especially with the earnings story looking for the next quarter looking actually a little bit better than we have seen. But the risks shouldn't be ignored. As much as investors are looking for industries, regions, themes, this remains a macro-driven market. Most of the variance, volatility is being driven by very few factors. Market correlations, volatility are very unusual, and there's a lot of fragility in the system. So all of this, if we think that what's driving, the very few factors which are driving this market are U.S.-China relations and the COVID pandemic, and we can see that on Monday mornings a lot of the time, then we have to be cautious. But it doesn't mean I'm giving up on the story yet. So I think it's just it's not a time for high conviction.
Okay, that's fair, Daniel. I think one thing that gives investors some reassurance, despite this uncertainty too, is the belief that whatever happens, the policymakers will still come and support the market. Certainly that's the belief with the Fed. You could say that about China's central bank too, and on the fiscal policy side. But my question to you is, to what extent do you worry about diminishing returns in terms of the impact of the upside from policy support? I know there are many tools left in most of these, well, in some of the toolkits, depending which central bank you're talking about. But just given that so much is baked in on policy optimism, I mean, what does that look like going forward?
Yeah, the way I think about that is the markets are actually a pretty good proxy for that right now. When we see the direction where are market participants going, they're more risk-seeking, but they're risk-seeking in the areas that policy is driving the investment thesis. And it's not an all-out search for growth at this point or growth proxies that are doing the best. And that means that that policy has to be a bridge to growth. That bridge can be very long, and it can be in place for quite some time, but we have to be able to see the shore on the other side before that bridge crashes into the sea. So I think that we're still, as you mentioned, there are diminishing returns to that policy response, and we have to be able to see where it's going. One of the biggest concerns I have is that, as you mentioned, these diminishing returns in terms of pumping liquidity into the system. That liquidity has to be transmitted by a real economy that's getting a grip on the road, and we're not seeing that yet. We're seeing that in actual slowdown in bank credit, for example.